Special webinar with Callum Thomas from Top Down Charts. So really grateful to have Callum here today. He's originally from Queenstown, beautiful skiing town. I've never been there myself. My wife's been there. Funnily enough, Queenstown always makes me think of Hurricane Ivan, strangely enough, because my wife and I had only been dating for about less than a year, and we came out this way, and I was over in Australia catching up with friends. She had some friends in Queenstown and was there for a week, and called me up one day and said, "Oh, I think there's a hurricane heading straight for Cayman." And I said, "Oh, no, it'll be right, don't worry." And then a couple of days later, she calls me and goes, "Yeah, you know that hurricane that pretty much wiped out Cayman, and I can't get hold of anyone." So every time I think of Queenstown, I think of Hurricane Ivan. But really appreciate Callum being here today. Really respect his insights into the market, and I know you guys are going to get a lot from today's session. He's got a master's in finance from Massey University. He's formerly a research analyst and an investment strategist. Used to work for AMP in both Sydney and New Zealand, and he founded Top Down Charts in 2016 as a chart-driven macro research house covering global asset allocation and economies. And he shares a lot of charts on Twitter, and he's also pretty active on Seeking Alpha, and he's someone who I follow pretty religiously, and I always really respect and look forward to the information that he puts out there. So Callum, is there anything else you can tell us about your background or what you're currently doing at the moment?
Yeah, sure. So, yeah, started the company just over 12 months ago now, and yeah, it's been a big change in going from big corporate down to a little startup. But the work's the same, the underlying work, and yeah, it's the market and the economy changes, but much of the process stays the same. I guess for context, where I come from is the institutional environment from an asset allocation perspective. So that's looking across the major asset classes, and having had much of my formative years in New Zealand and Australia, you're very much forced to look global. And certainly if you're an investor in Australia, you also have to pay attention to China, and that's something that I've put a lot of time into. And I guess just briefly also on the overall sort of philosophy or process that I take to analysing markets. Some people ask me, are you an economist? And I always say no. I mean, it's kind of like asking someone if they're a mathematician. They studied maths, but it was more as a means to an end. I learned economics as part of being an investor and a trader. And when it comes to markets, I like to basically look through as many different indicators as I can, and that means not being tied to the dogma of only fundamentals or only technicals. So very much a multi-factor approach. So might be starting with valuations, looking at what's going on with monetary policy, looking what's going on with the economics earnings cycle, what's going on with sentiment. And then, of course, technicals. I think it's wrong to ignore the technicals, but and it's equally as wrong to ignore the other aspects. And look, this is probably going to come through pretty clearly in this presentation that I'm about to go through. We're going to have a look at this low volatility environment and touch upon quite a few different angles there.
Yeah, that's great. I know my guys are really looking forward to hearing from you, and especially interested in what you're going to share about low volatility. Obviously, we're predominantly option traders here, so volatility is a big factor in what we do, and really looking forward to what you have to say. And in terms of top-down charts, you're mostly just doing research, or are you managing money for high net worth individuals or institutions, or is it mostly just research at this stage?
Yeah, it's pure and independent research. So no security advice or sales, and running $0 of money whether it's for the company or for myself, my view is that I'm here to be an analytical resource, and the moment I start putting my own money to work, that's going to sort of mess with my objectivity.
Yeah, absolutely. I can understand that. It can kind of cloud your judgment a little bit.
Yep.
Cool. All right, so just got a quick disclaimer to go through first before we get started, that anything contained in this presentation is for educational purposes only and should not be considered investment advice or a trade recommendation, and no representation is being made that any portfolio will or is likely to achieve profits or losses similar to those shown, and the risk of loss in trading securities and options in particular can be substantial. Make sure you check out the disclosure document, characteristics and risks of standardized options, available from optionstradingiq.com/risks. Is there anything else you would want to add to that, Callum, or does that kind of cover things from your side as well?
Yeah, ditto. I think I've got a disclaimer page on here which I can briefly flash up at the end or the start. But
all right, well, I'm going to cross my fingers here and make you the presenter, and hopefully all goes well from a tech standpoint. So I'll just switch that over to you now.
Right, just to be sure, it should be showing page 1 of the presentation.
Yeah, there we go. I can see that. So yeah, hopefully everyone else can as well. So I think we're good to go.
Great. All right. I just flashed that up for a second. This disclaimer there probably said the same things that you did.
Yeah.
All right. Well, into it then. So yeah, going to talk through this low volatility environment, or this low volatility regime that we're in. There's a lot of work on this that's out there, but hopefully you'll get something unique from my take on it. It's probably going to be interesting, me talking to options traders about implied volatility. You guys probably know a lot more about the specific details, but I'll be looking at this more from a top-down and macro kind of perspective, and really just taking three approaches here. So first, just a bit of a synopsis, so where things are sitting right now. A bit of a economic cycles prognosis, so how has this played out in the past and how might it play out from a business cycle perspective. And then also a bit of prognosis from a more market point of view, what some of the models are saying and some of the charts that I'm watching at least, and that we should probably pay attention to. All right, so straight into the first one, and this one here is what I call the alternative view of volatility, and really what this is doing is just tracking, looking at the last 252 trading days and saying how many days was the S&P 500 up or down by more than 1%. It's kind of an interesting rule of thumb for how much movement you're seeing in the market, and really it's quite an extraordinary picture here, and because what you've got here is that it's dropped to actually just 9, so nine trading days out of the last 252 saw any moves greater than 1%, and you have to go back to 1966 to find a similar environment there. And I'll probably come back to this one at the end because there's a few other things to say about it, but I'll just sort of focus on describing how things are at before we get into that. And this one here, I mean, the whole low implied volatility aspect, so we've got the VIX here, and the blue line is simply a composite of, or just an average of bond market volatility, currency market volatility, and commodities, just taking implied volatility for those markets and standardizing it just to make it a little bit more comparable. And you can see there that the same trend is pretty clear, that it's not just equity market, it's across the board, across different asset classes that we're seeing that. And then also into taking a global equity point of view, it's the same story. It's low, and then also looking at credit spreads, because it's quite often that you see credit spreads trading much in sync with volatility, and US high yield credit spreads basically one standard deviation below the long-term average, which is pretty exceptional. I guess the cautionary tale and probably one thing that we'll be thinking about a lot and talking about a lot during the next few slides is this period, 2004 to 2006, where, just because something's low, just because credit spreads are low doesn't mean that they, have to go up. Same thing with volatility. It can go low and stay low for quite a number of years. And it sort of goes to my point here, so what's the problem with low credit spreads and low volatility? Is it even a problem? And I'd probably show you in the next few slides, but pretty much the punchline is it's only a problem if it's lower than it, quote unquote, should be. And that'll become clear in a few slides. So moving into the economic cycles kind of prognosis, these two here, I talked about these in a blog post the other day, and what they show really is a picture of a maturing business cycle. And the business cycle matters, when it comes to moving in and out of different volatility regimes, because it's pretty much what guides what happens in the stock market as well. And I guess you can see it pretty clearly on these two here. You've got on the left-hand side there, US high-yield credit spreads, overlaid against the VIX. Pretty clear correlation there. And then you look at onto the right-hand side there. So that blue line there is a blend of the manufacturing PMI and jobless claims. And really all that's designed to do is to give you a guide or a gauge of what's going on in the economy, and with a bit of a cyclical viewpoint. And it's standardized, so it's, it moves around its long-term average there. It's a Z-score. And it's inverted to line up with the credit spreads there. Now, back to that point about, is it a problem? Is it not a problem? Probably the interesting bit on this chart on the right to me is that period in 2006 where you had credit spreads steadily grinding lower. At the same time, you had that economic indicator moving away from where credit spreads were. And so that's probably one of the key kind of warning signs or kind of clues that things may be about to turn that you would want to pay attention to. It's divergences that tend to produce the most powerful signals, and particularly when it comes to indicators like this. And at the moment, we're not seeing any signs of a turn yet. If anything, it's it's looking as good as it's been in years, and that goes back to this point about the business cycle. And we've got the yield curve here. A lot of talk going on about that recently. Tracks pretty closely to the unemployment rate, and essentially really gives you another view on the maturity of the business cycle. Looking at the historical experience there, you tend to get worried about it when it actually hits that zero line, or goes inverted. We're still quite away from that yet, but it does highlight the fact that it's taken a long time to move through this cycle from looking purely at the unemployment rate. It's taken a long time to move through from the bottom just back to normalcy, and I think really the maturing of this cycle is going to be key for making any sort of judgment or guess as to when volatility would start to turn. And you actually see that in the bond market volatility here. It also tends to have this sort of turn, when you get towards the end of a business cycle as well. And at the moment, we're just seeing record lows there, so it's it's pretty symptomatic of a maturing cycle, but at the moment we're not seeing anything to indicate that we're at the end of the cycle just yet. And speaking more on economic cycles, what they're usually ended by, except for the case of a crisis. So, I guess sort of throughout the previous points that I've made, really the underlying assumption or assertion is that to get a meaningful change in the level of volatility or the volatility regime, you need a change in the business cycle. Now, outside of a business cycle, financial crises and exogenous shocks, wars, etc., those can certainly play havoc onto it. But I guess what I'm talking about is, the big shifts, which is, transitions from bull markets to bear markets, and since the market tends to follow what the economy is doing, ultimately, what's happening with the Fed is pretty key as well. And in terms of where we're at on that front, we're pretty well into the tightening cycle by now, and I'd expect that it will probably continue on. Probably going to see another hike in December. But you look at the charts here. I've got two that I've talked about previously, and on the left you can see there that it's just from a first glance that looking purely at the Fed funds target rate, the number and degree of hikes and even the level of interest rates is it's just not comparable to the degree of tightening that we saw into the top of the dot-com peak and the subprime crisis peak. So in that respect, there's sort of in line with some of the previous comments there that it's they're going to have to do a lot more hikes and tightening before you start to get worried about the impact of the Fed. Certainly the quantitative tightening aspect is an unknown, but we can kind of track that there in terms of the shadow Fed funds rate. It was interesting to note, actually, that was something I was talking about back in 2015, is we'd had that massive tightening, at least on that front, which sort of was one of the catalysts that helped drove this twin corrections that did this whole reset before we could recommence this bull market that we're this very erratic and interesting phase of the bull market that we're into now. And then on the right there, it's basically comparing the Fed funds rate to where wage growth is. And the reason why I've put this one up or even looked at these two is that what you tend to find is when the Fed's fund rate is higher than wage growth, i.e. down below that 0% mark, that is often the point where you start to see the cycle turn, and the market's on borrowed time when you get to that kind of point. But we're still up very, very strong levels, so wage growth is still very comfortably ahead of where the Fed funds rate is at. So again, looking at this indicator alone, Fed funds rate would have to increase by 2 percentage points to get that to zero to become bearish on that indicator alone. So that's quite an interesting piece of context to to note in the background. Certainly wage growth could do the heavy lifting by collapsing, but again, if anything, I'd say that the weighted risk to wage growth is probably to the upside given how tight the labour market is at the moment. So anyway, that's a bit of a economic cycle prognosis, and I guess just a quick summary there is that in order to move out of this low volatility environment, in a big way, in a meaningful way, outside of causes like a financial crisis, a banking crisis, or some sort of geopolitical or external shock, in order to drive a sustained shift in volatility, in a more significant spike, you need to see a turn in the economics. And at this point, we're getting close to the end of the cycle, but we're certainly, there's nothing to say that we are at the end just yet. But there's a couple of interesting market models here that I thought I'd point out. This one here shows the VIX in the black line there against a couple of just single factor models. They just regressed there against the VIX, and they're all the things that you'd expect to see, like high yield credit, as we just talked about, that policy uncertainty indicator, realized volatility, claims, and of course the PMI itself. Interesting to note that, all of them except for the policy uncertainty indicator, they're all generally lower than usual, but even then the VIX is materially lower than where they would suggest that it should be. One interpretation of this chart is that it's kind of like a valuation model, and that when the black line goes above the various models, that means that it's undervalued, and when the black line goes below those models, that sort of is telling you that it's quote unquote overvalued. So it's a sort of another way to think about that. And then looking at the actual market itself, thinking specifically about sentiment, put it here together, this composite view of sentiment for the S&P 500, and it's combining the forward PE ratio, on the basis that forward PE ratios are essentially a confidence indicator, and that they reflect confidence of future earnings growth, and then the VIX there, just including that into the mix as a sort of a market-based pricing of sentiment, and then the bulls line there, that's bullish sentiment from the II and the AAII surveys. Combine it together and you get this kind of blended view of where sentiment's at, and it's sort of kind of difficult to see on that chart. You sort of have this optical illusions going on there, but it's precisely at where we saw it in the final stages of the dot-com boom. And you look at economic optimism as well, looking here at a few different measures, so the Philly Fed, the TIPP, both PMIs, the consumer confidence, small business confidence, just averaging that into one sort of collage, and you can see there that it's running fairly hot. So it's not what you see. These are not the kind of things that you see at the bottom. Certainly, you see them towards the end of a cycle. What you will probably see is them start to roll over at the end of a cycle. So of course, if the cycle gets ended by some sort of financial crisis or shock, it's going to happen before the indicators, that before they even start to show any signs of it. But under a normal sort of maturing and turning of the seasons, you'll see it show up in actually both of these charts. And then just finally wanted to point out just one corner of the market. This is looking at cyclicals versus defensives, and I try to be a bit cautious about throwing hyperbole around, like using the word bubble. People like to call everything a bubble these days, but you look at how stretched cyclicals versus defensives relative performance is at the moment. It's pretty extreme, and you can see there pretty clearly. You superimpose it against the S&P 500, and it's pretty clear what's been driving this renewed bull market. It's the cyclical sectors, and we've had a few times in the past where it's had really strong run like this. I guess in a more benign fashion into that sort of 97, 98 period there, where it just saw the market kind of top out for a bit. And then, of course, at the height of the dot-com boom, we saw that line up again into the final stages of the financial crisis, the final stages of that last market cycle, and then and again even in the post-crisis, immediately after the post-crisis period there, we saw it. So that's something that I would be thinking about shorter term. That sort of comes back to that point that I made at the start about technicals, that one good reason to use technical analysis is that price moves faster than fundamentals, and that's why we've got to look at indicators like this, because that economic optimism one is going to be quite useful for making big strategic shifts in allocations. But if you're trading week to week, day to day, it's not going to be it'll help you set your directional bias, but it's not going to be the one to make you make the move. And then just as a companion chart there, just looking at its price to book ratio, and you can argue whether the price to book ratio is the right kind of valuation indicator to be looking at for those sectors. But it's pretty remarkable where that's gotten to, the black line there, and even just the blue line there, the defensive sectors there. They're certainly not looking cheap versus where they've traded in the past. And I think I'll probably leave it there. I did have this. I'm not sure how we're doing for time. Oh yeah, we're doing all right. So just talk briefly about this one. So thinking about what's going to shift this volatility. What can shift it in the short term is that even over the medium term is that exogenous shock factor, and given that I mentioned China at the start, I should probably point out one of my favorite charts at the moment is this one here, so on the left. The thicker looking line there, that sort of dark bluey black color there, that's property prices in China, property price growth. And the other lines are basically just three different leading indicators of property price growth in China. And property is one of the key indicators that I look at globally and across economies, because it's just so critical to really the whole in just about anything that you want to look at in markets and in economies, because it drives growth, it drives risks, and drives monetary policy. And here, when you see an indicator, a leading indicator of property prices heading to the downside, that makes you pay attention from a risk standpoint. I would note that if it were going to follow them all the way down over to that negative side, that's probably going to show up early 2018. So a property market downturn in China is probably the big risks that I'd be watching for, probably number one on the risks that I'd be watching for in 2018. Haven't really done a 2018 outlook yet, but this will probably be the first one on the list. And why China? What does China matter to the S&P 500? Well, if you think back to, you can kind of hardly see it on this chart there, but if you think back to those twin corrections that we had, the first one really was catalyzed or triggered by China. There was a few other warning signs going on at that moment, like that sentiment indicator being very frothy, but didn't take that much. All it took was a bungled move to a new and that to their minds, they thought it was a fairly simple move to just a new way to set the market price, and triggered all these reverberations around the world. And so if we see property market downturn in China, that's the kind of thing that can trigger off a few other risks that are sort of sitting behind the surface there. And even just a headline aspect, property prices going negative year on year in China, that's going to certainly be the kind of thing that's going to impact on sentiment. And before I make my final point, I guess that sums up or kind of highlights that line. I think I put it in an article recently, is you think about all the stuff that I've talked about today, and you think the risk of a sell-off is pretty high. The risk of a correction is fairly high as well, but the risk of a bear market would be medium to low at this point. So and I guess just since I mentioned at the start, the final point that I'd make on here is that this whole idea about volatility moving with the business cycle, you can kind of see it in this chart, and it's very much doing what it tends to do at the early stage of a bull market. It's when it turns around that things start to get interesting, and we're not yet to see that. So I think I'll probably leave it at that, and did you want to do some Q&A, or did you yourself have any questions about that?
Yeah, definitely. No, thanks, Callum. That was awesome. Really informative and lots of great charts and info that you've shared. I did have a couple of questions, and then we could throw to um, the others if they have any questions. I think you kind of covered a few of them that I had, but yeah, basically looking at this chart, I guess just one observation is that sort of that 93 to 95, 96 period where we saw such low volatility as well, that was actually a precursor to a really massive bear run. So I guess even though we've got this incredible low volatility at the moment, there's no real reason why that can't continue for a little while longer. Is that sort of, you in agreement with that?
Yeah, exactly. I guess where's it gone? That credit spreads chart, like um, being underweight credit at this point. I mean, being not invested in credit is probably a fairly consensus view, but actually going short credit at this point is a big call to make, especially with the spectre of that 2004 to '06 period. Yeah, it looks too low. Yeah, it looks kind of overvalued, but until you see the cycle turn, it's you kind of need to have those factors line up before you can really have conviction. Otherwise, you might be sitting there for the next couple of years getting steamrolled as the market marches higher.
Yeah, exactly. I guess you've kind of touched on it a little bit, but some of we're in a pretty Goldilocks environment at the moment, I guess, where everything's sort of at fairly extreme levels, but it hasn't really turned yet. Is there any, other than the credit spreads, is that kind of the main thing you'd be looking at as like an early warning sign, canary in the coal mine sort of thing? Or is there anything else as well that you're looking at?
Yeah, those are, I mean, a lot of those ones are kind of coincident indicators, I guess. I mean, monetary policy, again, everyone's looking at it, I guess, but it's just one of those key ones that you have to look at. And I think there's been a few financial conditions charts floating around, and we can question the merits of that indicator, but we've seen financial conditions actually become looser so far as the Fed's hiked. So yeah, I think you need to see a lot more hiking on that. That's probably going to be a pretty good leading indicator. I mean, for America, increasingly now you have to look globally as well. So when we saw emerging markets have their mini recession in 2015, that that was pretty key in driving that sort of bout of volatility that we saw there as well. So I'd be looking at what's going on globally, be paying pretty close attention to that, what's going on with monetary policy. A few other surveys like the Senior Loan Officer Survey, that there's been some interesting signals coming out of that more recently, but then they've also sort of calmed down as well. And then just fairly vanilla stuff like the economic optimism numbers. You take a composite view there, and it's still just ticking along. It's nothing's rolled over yet. They're just Goldilocksing along, and of course property prices, property market.
Okay. I guess this is a bit of a tough one, but I'll throw it to you anyway and see if you have any comments. But we've seen a couple of pretty bad bear markets recently. Obviously, the first one, the tech bubble bursting, and then the second one caused by housing. Is there anything that you could see causing the next shock potentially? Like I know a lot of people are short volatility at the moment. Maybe that's an area where people have taken too much exposure, or is it Chinese property? Is it, obviously very hard to predict these sort of things, but is there anything that you foresee could potentially cause the next shock in the markets?
Um, well, I guess your starting point is just the plain old, fairly vanilla example of the business cycle itself. Just a just the just a normal old recession itself would do quite a lot of the work for that. I guess in terms of what kind of shocks or crises could eventuate, it's kind of that in many ways it's one of those things that are harder to predict. And unless I've got pretty good indicators of information to back it, I personally try to steer clear of making such kind of predictions. One of my personal axioms is to look at what the facts are. Look at what trade on what you see, not what you want to see, and that's why I got this sort of focus on charts and indicators. Try to make it as fact-driven as possible, and try to reduce the amount of forecasts going into the mix. But external shocks like China, I mean, that's probably pretty high on the list. Korea, tends to drift in and out of the headlines. That's it's still pretty elevated risk from that, and the last I've read on that is that they've going for a bit of period of calm at the moment because it's winter there at the moment, and it's during the winter time it's harder to do anything, harder to do missile launches, and they've got to spend money on things like heating and that, so it's hard to get money and fuel for doing missile tests. They've got to sort of just focus on surviving the winter. But they could come back in force early next year in the lead up to the Winter Olympics. I think it's in February in South Korea, and it's been nothing like some sort of escalation in the type of testing to rattle markets there. Again, that's kind of a standard type of geopolitical risk. The way I think about geopolitical risks, unless they involve big regional conflict, or they involve a conflict with an economically meaningful country, they're usually more buying events or trading events than anything. And I mean that whole short volatility trade, I don't know, I don't really buy that would be something that would cause systemic issues. I mean, you look at the amount of assets under management in the short ETFs, it's just not material. And if the VIX was going to spike enough to wipe out those ETFs and to wipe out those traders, I think there's probably something that's been driving that spike, and that's probably the least of our worries. There's probably something bigger and hairier out there than a few traders getting wiped out.
Yeah, it definitely makes sense. Haven't seen too many questions come through from the audience, but I guess just one final one from me following on from that last one. I guess we've seen two pretty bad crises in our, or this sort of cycle or this generation. Is it possible that maybe we won't see another one for quite some time? Maybe we'll just have, as you said, a normal plain vanilla recession will be the next one rather than some sort of crisis?
Yeah, I kind of am leaning towards that viewpoint. I think it's fairly popular to assume that the next downturn is going to be some disastrous thing that's going to make the financial crisis look like a walk in the park. I think that's quite popular in some circles to have that view, and it's quite understandable to have a view like that because just recency bias. These kinds of events, by their nature, tend to be fairly unique. I'd say that, and I think that there's been a lot of changes in even just in macroeconomic policy. The next, I think that the Fed would probably be even more active, going into the next one in terms of how they try to manage the cycle. I think it's inevitable that we'll see another round of quantitative easing in America. You just need another recession or crisis to take hold, and it's now become really accepted policy. It went from unconventional to now fairly conventional policy. So, I think that it's quite tempting to think that the next one will be some kind of major disaster, and who knows, maybe I'll be wrong. But even in a sort of I guess what I call a plain vanilla business cycle driven downturn, you can still see a fairly sizable bear market, in terms of just stocks themselves. So, I wouldn't. I'd say that the odds that we see another crisis and Great Recession that we just went through in 2008, the odds that we see one again in the next year or two, I'd say that the odds are pretty low. But the odds that we see a recession that makes a big dent still makes a big dent on the economy, and still poses a significant threat to portfolios, is it's definitely real. I guess maybe it's just splitting hairs. It's kind of the difference between a 30% down bear market and a 70% down bear market. You still get you still want to manage your portfolio around that, and that means reducing risk when the signs say that you should be.
Yeah, definitely makes sense. All right, so just one question from the audience. Probably already covered this to some extent, but is the low vol environment a bit of a signal for a continued market advance?
Yeah, well, that's one thing that I've been thinking about, I thought about a while ago, is that it can sort of have a self-reinforcing effect in a way. If low volatility, one thing that low volatility can do is actually make people a bit more comfortable about getting into the market. So, anyone who's grown up, who hasn't really, who's had their sort of formative years around these periods of extreme volatility where, for this whole 10-year period, the market hadn't gone up for a lot of people that, invested in the top of 2000, they have to wait, at least, probably more than 10 years, I think it is, to see stocks go up. So if you're in an environment where there is less volatility, and you look at what the S&P 500 is doing at a headline level, it's just, you look at the last year, stocks only go up is kind of, a crass kind of conclusion you can make from that. And that's, thinking about beginners or even just, the average punter, they see that, and, tends to make them a bit more confident. And, you can see that in the economic confidence, the euphoria meter, that can have a, sort of a virtuous cycle effect. And then I guess also just to make it even more complicated, you look at that period, leading into the dot-com mania, you actually saw volatility going up, as it moved from this fairly similar environment that we're going through now, where it just, almost went up in a straight line, no major drawdowns, and then things got a bit more erratic as people, started to get, I guess, that fear of missing out, and the animal spirits sort of take hold.
Okay, and just another question. Do you have any opinion on, uh, I guess, both money supply and demographics? I guess in terms of money supply, we've got, um, a lot of stock buybacks have been happening. The Fed's starting to now tighten. Who's left to buy into the market? And then in terms of demographics, do you think the baby boomers have anything to do with the rally that we're seeing at the moment in terms of, there's not enough yield in bonds, so they're having to pour money into the stock market? Do you think that's having any impact at all at the moment?
Um, yeah, it's a good question. So, I mean, starting with the money supply aspect, it's not one that I tend to look at that closely. So, um, I don't know if I'd have that greater insight on it. I think, the corporate buybacks theme has obviously been important, but it's not been without an advancement in fundamentals, and it's not been without greater participation in the market by the household sector. And so, I mean, definitely monetary policy tightening is going to be very important for the duration, or the longevity of this cycle. And that was kind of, I guess, what I was trying to head on this on these two slides here. If you think that quantitative easing was helpful, then quantitative tightening has to be a headwind. And sooner or later, if you hike rates enough, it'll break the economy. And certainly if you hike it greater than the pace of wage growth, we'll kind of see there is it's those are the kind of things that impact on the longevity of a market cycle as well as the business cycle. So I guess that would be my thoughts on that. In terms of demographics, yeah, I don't have any data on that. I mean, and I guess if you look at some of the indicators like the earnings yield spread to bond yields or equity risk premium, those are things that have certainly been supportive for the market. And from a financial conditions perspective, low yields, they do a lot of good for the market in a lot of different ways. Makes it easier for companies to buy back stock, makes it easier for companies to either just withstand higher debt levels, improves their profitability. If they've got a lot of debt and interest rates drop, it frees up a bit of money from paying down debt, or paying interest rather. And in terms of switching out of bonds into equities, I'd say it would be probably more of a we've seen it more clearly in other income assets or alternative income assets. So you definitely see it in utilities. The MLPs, although they got a bit complicated by the energy story, REITs, credit, all the other various income assets. And there's that chart that got a lot of attention that I put out there. It was ETF assets under management in the various income products, and that had gone from virtually just immaterial around the crisis, and then now it's $500 billion is in that sector. And so there's the chase for yield is definitely real, but I would be a little bit skeptical that people are necessarily substituting stocks for bonds or other sort of more pure income kind of products. It's certainly been a big driver of the good run in credit that we've seen, and I guess that's one area that I'd be paying a bit of attention to. That's probably one channel that another thing to think about there is that as the economic cycle matures, that means what you get, you tend to see higher growth, you tend to see higher inflation, and bonds tend to underperform. And that's just another way of saying that government bond yields, if they headed up, if bond yields head up in a meaningful way, then maybe you see people, those income chasers rotating back out of, the risky incomes that are on offer and credit back into the more safer incomes if the yields justify it. It's only a couple of years ago that you were getting 0% for your money, and now it's 1.25% the Fed funds rate. So wonder how much further they need to go up before people start to think maybe lower risk cash, not that higher income, but still 1 or 2 or 3% maybe starts to look better than credit. And more people, if people migrate en masse out of credit, that could cause a few hiccups, because credit is an income asset, but it's also a risk asset, and also has these flow-on impacts into the stock market. Even if you think about companies buying back stock, they the yield chasers are the ones that are giving them that good availability to borrow into the markets and do that. So I don't have any data per se on the breakdown of who's buying into the stocks, whether it's the baby boomers or some other demographic. I think probably all the younger people are probably buying into Bitcoin rather than stocks, but that's a topic for another day.
Yeah, definitely. And I guess just one final question from the audience. Do you have any view on the Indian market? I guess if not Indian markets, maybe emerging markets in general?
Well, I guess emerging markets in general, I can look into that and get back to you, but emerging markets in general, I guess looking through those multiple factors lens, you look at valuations there. In absolute terms, they're no longer cheap, or no longer trading below their long-term average. So absolute terms, they're not the value play that they were a few years ago. Relative terms, they're still, pretty substantial discount. I think the last time I looked at it was sort of around 30% discount to where developed markets are trading. So there's still a relative value case there. In terms of the rest of the view on emerging markets, it's interesting there actually. There's been another wave of monetary policy easing across emerging markets over the last sort of 12 months. You look at the composite monetary policy rate for developed economies, and it's on the rise thanks to the US and a couple of others. But you look at emerging market, they've gone the other way. They're there's a few banks that have been unwinding the tightening they did previously, like Brazil and Russia, and a bunch of the Asian ones been cutting as well. So like the likes of India, and monetary policy matters for the stock market, obviously, for a number of good reasons, and also matters for the earnings and economic cycle. And I look at some of the composite, at a composite view for emerging markets, at an aggregate level. I look at the cyclical indicators that I watch there, and they've been improving. You can see a pretty clear link there. When the aggregate monetary policy rate drops for emerging markets, you see a cyclical improvement. So, you've got a situation of there's a relative value case, whereas, absolute terms, it's no longer a value play. And, if you think about where you're at in the cycle, that kind of makes sense, with the easing coming through and helping a cyclical upturn there. But, one thing I would notice is sentiment towards emerging markets is running pretty hot, and for good reason. They've had a really good run off the bottom in 2016. But yeah, seen massive flows into emerging market ETFs. So I would say that the easy gains have been had for emerging markets, and from here you're kind of relying on the cycle just to tick along without any of those risks that tend to pop up in emerging markets. Without those sort of surfacing, they could do okay still.
Okay, awesome. Thanks for that. So we're getting up on near an hour, so don't want to take up any more of your time, but just want to thank you so much for coming on today and sharing all that awesome info. And what's the best place for people to find you? I guess you're pretty active on Twitter. Is that sort of the main place to find
Yeah,
your top-down charts on Twitter?
yeah. Just Google top-down charts, you'll find us, and you'll find your favorite channel.
Awesome. Well, thanks again, and I'll speak for everyone who's on the call. Really appreciate you coming on, and really appreciate all the info that you've shared today.
Great, pleasure.
Cool. Thanks, Callum. Cheers, mate.
Cheers.